Good morning still, because it is prior to noontime, and I'm really glad that we still have some people that didn't leave but remained. And I think that we have the most exciting topic here for the startups, because as also Priit said, that despite of the dream of a startup founder to reach an IPO, the IPOs are only a marginal exit versions. The majority of the exits come from different M&A transactions, whether you are acquired or whether the startup is merged with another company. So that means basically that M&As are the key component of the startup economy. And that's why we are also presenting that topic here. Very lovely to have you here as the audience. And now I'm happy to ask my lovely panelists to also join me on that stage. And today we have represented the most important part of the M&A world, because over 80% of the M&A activity of the startups is happening in North America and Europe. 86% of the deals based on the Crunchbase data are done in Europe and North America, and that represents approximately of 80% of the value of the deals. And that's why I'm very glad that we here have today represented Central Eastern Europe. I asked Bogy, Skowronski from Nomad Fund to join me. Please give a warm hand. Please choose a seat. Then Robert Lees, representing London as the city of exits in Europe, from Strata Technology Partners. We have very strange seats here, but you can be very innovative in selecting one. Or that one? That one, good. And then the US part, represented by Kyle Poyar from OpenView Ventures Partners from Boston. So, and let's start with it. Why are we here? Why are you here first? So, what gives you the reason to be on that stage today? Let's start with Bogy.
Hello, everybody. Delighted to be in Tallinn. My first time to Tallinn, I must say, but delighted to be here. Very impressed with what I see. I wanted to share with you a little bit of my history. So in the 90s and up to 2007, I have been running a corporate finance house. It was a family office based in Zurich, and we were helping Polish entrepreneurs to actually build bigger companies, big companies. So we've done a lot of M&As with multinationals who then were entering Eastern Europe. So the value building was done all through M&A. Then all of a sudden, things changed, and we saw a lot of activity on the Warsaw Stock Exchange, because as you may know, some of you, New Connect market was created. New Connect had the ambition to mirror what AIM has done for European companies. New Connect said we are going to do it for Central and Eastern Europe. And at that time, I became a nomad and was listing companies from Poland, from the Czech Republic, a very, very active market. Approximately a year, we had sometimes, in some years, 100 listings. And this was a way to get capital for companies, not necessarily exit, but get fresh capital. And later, when we discuss, I'll share with you some experiences from that. And in 2015, we have created with few other of my partners, we have created a tech accelerator linked to Boston, linked to MIT, to basically help tech founders from Central and Eastern Europe develop global companies. And through that, we are, through the accelerator, we surround the accelerator also with VC funds, with angel investors, with lots of international mentors to help them develop the skills and also connect with other people that will help them build international companies. So I would like to share these three types of experiences with you.
So there's a lot of ground for Bogy to be on that stage. So really happy for that. Thank you. So Robert, why are you here?
Thanks. Hi, everyone. So I run a technology-focused corporate finance firm called Strata Partners in London, and we advise technology companies and life sciences companies on doing three things. We help them buy businesses, we help them sell either part of their business or their whole business, and we help them raise capital. And I've been coming to Estonia for 7 or 8 years now. One of my first clients here was a company called FitsMe. They did something very cool using robots for the online fashion industry. And we helped...
Sorry, Robert. How many of you know FitsMe case? Hands up. So, we are familiar with that case.
Okay, great. And so we helped FitsMe. They got their first money actually from Estonian Development Capital, as it was in English, but then raised money from funds in London and Helsinki, and we helped them on that journey. And then a few years later, we helped them with their exit to Rakuten. We've helped a couple of other companies here in Estonia, also a few companies in Finland. Probably the most famous one there is Holvi, which was a bank for micro business. And we ran a really nice process where we had an investment option from a major global bank and also an acquisition option, and they decided to sell to BBVA. So we found that there's really good entrepreneurs here. They build really great businesses with great technology, but then the journey from getting to the startup phase through to the growth phase and then the exit phase, there's not enough people here who are focused on that. And so we have a commitment to this region. We really want to help companies get bigger, maybe move to another country if they want to, if that's part of their journey, maybe exit. We don't do IPOs ourselves, but if we can get them shipshape to do an IPO, they'll still be a friend. We can advise them on acquisitions later on. So I'm here to find business opportunities and help companies from the region.
Thank you, Robert. I can see that you have fallen in love with Estonia already and the Estonian startups with that long history that you have had. So, Kyle, coming from Boston, so what is your reason of being here in Tallinn at Latitude 59?
Yeah, well, thanks for having me. So I'm from OpenView Venture Partners. We are about 12 years old. We have $1 billion in assets under management, and we invest exclusively in B2B software companies at the expansion stage. And a major area of focus for the firm is on post-investment work. And I'm VP of Market Strategy there, where I'm working with our portfolio on growth initiatives, and I'm also helping them think about exit strategies. And where I come into play is well before a company is ready to hire a bank and have a formal M&A process, we're helping them think through what's the best sort of next step for them. Is it more financing? Are they looking to kind of get to cash flow sort of break even and then pursue maybe some M&A down the road? Do they need to acquire companies themselves to be more successful, to really roll up the business? So we're helping them think through what does that exit look like well before the process begins. And I mean, I think it's super important. We actually had a portfolio company just about a week or so ago announce an intention to be acquired by Pluralsight for $170 million. That was a Series A deal, and they really had that opportunity because they were doing some of these things in a smart way. So excited to share opportunities about that. The other thing I'll note is I run OpenView's benchmarking and metrics initiative. So we're collecting data from 400 or 500 companies every year around software metrics, around growth rates, burn, every sort of operational financial metric you can think of for both private software companies and then public companies as well.
A very good reason to take that stage. So we have introduced ourselves. What about you? Who are you? So the startup people, founders, hands up so that we could see you. So some of you. So the investors, hands up. A few, not too bad. So just get to see the hands to see that you want to be connected afterwards. So, and also to think that who are the people in the panel you want to introduce yourself. So, who else do we have? Advisors, some supporters of the ecosystem, some I see in the last row. So, mentors, some mentors also. Yari.
Yes.
Very good. So, anybody who wants to introduce himself in 2 sentences to be more visible for the whole audience. So, 2 sentences, please. Lady, you have lost your voice. So,
I'm Evgenia, Russian, Belgium. My startup, Eventify Life, is building an ecosystem for event organization who bring people to the more meaningful lifestyle, means culture, sports, and creativity.
why are you in that session?
I would like to find, actually, to substitute my co-founder, that's one thing. Might be finding extra investors, and actually we are launching in Tallinn. Our first rollout city is going to be Tallinn, because I love this city and country.
Wow, very good, thank you. And then we have another brave heart, Adel, who also wants to introduce himself and saying why he is in that M&A session.
Yeah, I'm Adel, CEO of Portal 365. We build management and grant writing system for NGOs. It's a different sector, but we build technology for them. Nobody is focusing on that. And we need to learn a lot because it's very different thing. I'm sure I will learn a lot from the speakers.
What's your first question for the session? What do you want to know?
Yeah, I would know that, like, I mean, there are, yeah, so is it usually like the founders should usually think about exit, or it's not? I mean, like for me, I feel like I'm very attached to the startup. I can't even imagine that I will reach the exit.
Okay,
I don't want that.
Thank you, Adel.
Yeah.
Very good question. Should the founders think of the exit from the very beginning? That is a very good start, because the title of our session is M&A, the strategy and execution. There are definitely some startups that are built for being acquired from the very beginning. But I have thought always that the reason of being a startup founder is building a sustainable business. And in course of that track, you have to fundraise occasionally in order to be faster, because money gives you some boost, the additional energy that is needed. So let's kick it off. What do you think should the startup founders, when they start their companies, keep in mind the exit?
There are different people, obviously. Many founders that we found, we look for passion, persistence, and huge attachment to what people are doing. And it's actually very difficult. I mean, it's kind of a custom thing that VCs come and say, okay, but I want to have certain rights. Even if I have minority in the company, I want to have certain rights. And in some situations, I can drag you, right? I can force you to sell your company. I think it's important for the VCs to do that. We all know why, but it's also a very brutal thing, I thought, you know, and when I worked on New Connect, you know, bringing companies to the stock exchange, the thing that I thought was really terrific about the IPOs is that you basically, once you list, you can get capital over and over and over again, and no one is going to drag you to anything, because the shareholders, you know, the other public shareholders, they don't have really the rights. I mean, it hardly happens that someone would drag you to basically get rid of your company. So it's really unfortunate, I think, that nowadays in Europe, we don't really have a stock exchange which is really accessible to young companies. We really don't have it anymore. I think AIM is not really accessible. NASDAQ is not accessible. If we look at the numbers, there is, you know, I think in the high side about 17 years ago, there was about 7,500 companies, public companies, technology companies listed. Right now, it's half of that. So the trend is definitely down. And big pools of money are moving to the venture funds. You know, this is really where the action is. And in the M&A, because the big corporates have decided that it's much cheaper for them to buy innovation versus invest in R&D. So you see accelerators like ours, you know, you see corporate partners basically flocking to centers, ecosystems where there is innovation happening. They are not inventing themselves anymore. They're buying things, they're paying premium. This wasn't like this 15 years ago, right? I mean, doing an IPO was a huge thing. I mean, everybody made money during the IPO. Look at what happened to Lyft and Uber, right? It's no longer the story. So I think there is a need, in my view, for creating a stock exchange that would be accessible and that allows for founders to basically persist and build their business and not live under threat of being exited, dragged, whatever, you know, at some point. But there are people, of course, startups that are built for exit. So I think it depends on the personality.
I'm going to push back on that. So I think you brought up some great points, but from my perspective as a VC, we're not dragging anyone to exits, but we think about it as a founder, you need to be creating optionality for the business, right? So you need to be preparing for different scenarios that could happen and make sure that you're sort of planting the right seeds, and that happens early on, right? So if you want to sell, for instance, to Microsoft or to Salesforce or Oracle, that probably doesn't happen because you decide one day you're ready to sell, you hire a banker, and then a few weeks later you have an acquisition offer. That's not how it works these days. Especially if you're at some sort of scale for the business. Rather, you want to be building relationships early on, talking to product folks, GMs of different business units, the folks that matter at the companies that are interesting for you. And then you want to be essentially learning from them, right? So you can learn a lot of great market intel. You can learn how they view the space, whether you're competitive or complementary and how. And then you can maybe build a product partnership or integration. That could be helpful to grow your business independently because you have these partners that can help you reach new customers or reach new markets. And then down the road, you're essentially dating before you marry, right? So now all of a sudden, like you are a known entity, the risk for that buyer is really low. They know you, they know the product, they know it's compatible, they know the customer base is compatible, and they're willing to pay a whole lot more when an exit is ready. And you still manage the exit on your timeline. And if you want to continue building an independent business and go public, or just maintain having an independent business as a bootstrap founder, that's certainly fine. But now all of a sudden, more paths have opened because you've done some of that pre-work to put yourself in the right position.
Thank you, Kyle. Adel, it's a very simple situation. It's always better to be attractive, to be acquired, somebody approaching you as a beautiful bride, basically, than sit in the corner and think that, okay, I should sell. So I think that if you decide whether to build your company for exit or not, then just build first a great company so that everybody admires it, and then you have a wide selection of potential grooms. So, Robert, what do you think?
Yeah, I think it's the choice of the owners of the company. And if you as a founder maintain ownership, you have the majority of the shares and you're able to run the company without taking in a lot of external capital, what you choose to do is up to you, right? Absolutely. If, however, you rely on other people to fund your company, or you're giving your employees options to work for your company, in a sense, you're taking an obligation to give them liquidity further on. So I think it really depends on that. But I completely agree with some of the earlier comments. Make your company as attractive as you can, run it well, find a really good path to being attractive, and then you'll have a lot of choice as to whether to sell, on what terms to sell, whether you want to consider an IPO, whether you want to do growth equity and then private equity to stay in control of your company for the longer term. There's a lot of options for good, well-run companies.
So, a little bit of statistics. I'm pretty sure that you are aware of that. But just as a remark, based on the Crunchbase data, within 2018, there were only 4,200 exits based on Crunchbase data. So, but Crunchbase has a lot of data. And the value of those exits was around 2,200 billion US dollars. So, I'm pretty sure also that you know, oh, perhaps you don't know. So, a question. What do you think? What is the percentage of startups that don't make money at the exit? Wild guess. That have burned the invested money and do not return positive outcome. How much? 90? If to say so, that they don't return the money that has been invested, so that the founders have put their sweat and tears and blood anyway into the company, but that is not accounted for the monetary terms right now. Let's say for the people who have put money into the company. So, what is their guess? Hi, Petri, nice to see you. 99%. And that is from a Finnish VC, not VC, but early investor that is of angel type of investor, having still a fund. His personal experience is 99% of the startups don't provide positive monetary returns. Anybody else? Wild guesses? How much? 12. No, how many startups don't bring any return? How many die without positive returns? 70%, 80%, 99%. Any other guesses? 8-ish. Actually, it's around 60. So 59% of the startups don't bring back the positive returns regarding the money invested. So if you think of the exit perspective, and a lot of exits, no exit, no party. If you want to have a party, be prepared to have an exit with positive returns. So let's go back to the market. The trends that you see, we have the US, the continental Europe, and the UK as the capital of the exits in Europe, so that representing a huge proportion of European exits. What are the currently trends in the market? Do you see that there are certain companies, certain industries, certain countries that are preferred? Or do you see that people want to give the shares, to keep their shares of their companies, not to give them to anybody else? What is happening currently, in your opinion?
Well, so, a trend from my experience, so obviously IPOs, while we've seen some big public ones this year, especially Uber and Lyft, IPOs are still very difficult. The bar is higher than ever to IPO. You have to have really amazing metrics or the stock market is not going to reward you. And so people are looking at exit opportunities with strategic partners or with private equity. But then with strategic partners, a lot of them have made some pretty big acquisitions over the last couple of years and so have slowed down as they digest those. And so if you look at businesses like Oracle, Salesforce, they've moved towards bigger buyouts of companies and have just generally have not had the activity that we've seen from years past. And so that actually leads to private equity as stepping in to fill the void. Private equity and growth equity firms have been actually a majority of technology buyouts in the last couple of years. And the reason why is they have a lot more money now. They're more familiar with technology businesses and they're able to measure them better. And they just know that they need to be more competitive on deals. And so the sense before was selling to private equity, or giving private equity a majority control transaction. There was sense before that that was a bad thing, right? That these are sort of bottom feeders, they're going to rip apart your company, cut costs, hurt morale. Nowadays, we're seeing private equity buying growing companies like MindBody being bought by Vista, and allowing those companies to continue to grow, combining them with other entities so that they can reach scale more effectively, and making some key operational changes in the business, and then exiting further. And so Marketo is a great example. They were bought out by Vista, and it was a growing company. Vista helped them grow even faster and more efficiently. And then they were able to have an exit to Adobe that returned quite a bit of money to all parties involved. So I would say the key trend is don't ignore private equity. It's a lot more attractive than you might think.
So you are saying that private equity is actually taking over the VC market, so that instead of thinking of fundraising from the VC investors for the next round, be also prepared there is an option to sell a part of their company or the whole company to a private equity firm. So what do you think? Do you see the same trend also in Europe?
Oh, I work primarily in Central and Eastern Europe, and I think CEE is very interesting for the moment because compared to maybe the rest of continental Europe, we are a little bit forgotten. If you look at the amount of capital per GDP, it's lower, especially when it goes for the bigger rounds. Estonia is special. Estonia is, together with the Nordic countries, definitely a digital forerunner in Europe. But if you look at the big markets like France and Germany, there's lots of capital, but maybe not as much talent as I would see or in relative terms to Central and Eastern Europe. I think it's a very, very interesting region. That's why we're focusing on it. And because, especially for the ecosystem builders, because you have lots of corporates, local corporates, which really need innovation. And we see it because we basically talk to many corporate partners to invite them to be the sponsors of the accelerator. So where we see a lot of activity and a very big interest is in the fintech, insurtech. Remember, the banks, really, in our part of the world, they were starting completely from scratch, right, after 1989. They had to build a completely different system. So they don't have as many legacy systems as maybe in other countries. So, for example, in Poland, the banks are extremely innovative. You know, all the applications, you know, basically doing everything through mobile. We were doing it for a long time already. So it's easier for banks to adapt because they've been doing it, and they're very interested to continue. So we see lots of interest in fintech, insurtech, lots of interest in proptech because, you know, there's plenty of construction development. So all the development companies are very interested in proptech technologies. We have some interest in life science, lots of good engineers in life science, but the big companies from America, from Ireland, they're really not, their R&D departments are not in Central and Eastern Europe. So this is a difficulty for the Central and Eastern European startups. And what we have basically decided to do within MITEF is to kind of build a bridge to Silicon Valley through our partners, founder partners in California, and through the team to Candle Square to MIT, to help the entrepreneurs to actually bridge and go to the either continental Europe or go to the US to build their businesses. So that's kind of our foray. But from the Central and Eastern Europe, I just see a lot of potential, longer term potential. You know, that's where the actions will be happening, I think, for the next 10 years in a big way.
Bogy, you think that the better track for the European startups also would be the bridge to the States?
I think the Central and Eastern Europe, to me, is still somewhat disconnected. Mm-hmm. We are generally smaller markets, so we have to think of other countries. We could go, of course, to places like, you know, continental Europe, or even Madame President mentioned Africa. There are lots of Estonian companies, you know, actually build presence there. It's a very interesting strategy. I think there is still so much to do in the States. You know, if you have good connections and good teams, I think you can really do a lot. So I favor States.
Okay, so Robert, what about on the view from London? So are there any good European, UK M&A deals?
Yeah, I'm going to go back to your earlier question of what are the key trends I see, which I think are relevant to startups. And I think the real focus of buyers in M&A are two things: recurring revenues, the quality of the revenues that you've got, and the growth that you're able to achieve. And so we've worked on lots of deals, funding deals, but also M&A deals. And what people are looking for is growth. Strategics want to find new sources of growth. Innovation is part of that. And if you can show a company that's growing well, and that there's a high propensity for those revenues to come back year after year after year, buyers will be very interested in your business. If your business is providing one-off services, consulting, software build, and so on, there are buyers for those businesses, but it's much harder. The valuations typically are lower for those kind of revenues, and you might run a process and find that nobody's interested because they see risks and so on. So I think for startups out there, one of the key things I would say is, it doesn't matter where you're from, whether you're from Central and Eastern Europe, whether you're from Western Europe, or the US, or anywhere else in the world, if you can find a model where you have recurring revenues that grow over time, you will find great success. People will be interested in what you do. If not, you can still sometimes find success. People will buy your IP or your people, but it's much less easy to be sure that you're going to get that great success, right? It can happen, it does happen, but it's much harder. So I think for startups, you can think about long-term, is private equity the buyer or whatever. It doesn't really matter. If you build a business with recurring revenues that grows year on year, I think you'll do very well. So I wanted to answer that question first. I'm happy to come to your other one.
Yeah, the other one was that, actually you partly also answered that one. So that, do you see there are good M&A like opportunities in London for the European startups?
Absolutely. And we just sold a very nice SaaS business, which was UK headquartered in an auction. We had 3 US bidders, all private equity backed, who gave us good offers, but there was a British ERP company that actually paid a higher price, easier deal terms, and so we chose them. That company has got to 150 million pounds of revenues, very profitable in the UK. And they're now saying, we can keep growing in the UK, but we have to start thinking about other countries. Where do we go next? Do we go to Germany? Do we go to, well, we go to Ireland. That's kind of for UK companies, that's a very natural next step. Do we think about the US? Do we go to France? And so we're now going to engage with that company because they've replicated a model where they have good technology, but they have very good sales and marketing. So they can buy a small company, bring it into their business, connect it to their ERP, and then sell industry-specific applications very effectively with their sales and marketing teams. What they believe is that there's lots of other great companies out there that get to a certain size, don't have the sales and marketing that they can bring, and they'd like to find those companies in a new European market and start buying them. And I think that's a very common trend. Once somebody gets to a certain size in their domestic market, almost no matter how big, they have to start thinking about where else do we go, and do we have a specific skill set that we can apply somewhere else that's relevant. And I think we're going to see a lot of UK companies trying to diversify away from the risks of Brexit and so on by setting up presences in other countries as well. So I think that's another driver.
Very good. What I have seen so far is that the startups, they have very high ambitions. They basically aim for the stars, and that's very positive. Being high in the sky always does not give enough assurance for the investor. There are some like Dualtracks. There are the VC investors who really look for the very high aiming startups, definitely with attraction as well. And there are the investors that think that, okay, if we can build a company with a value of 20, 30, 40 million euros, dollars, that is good enough. So whether you have here like the different feeling, whether the market is developing in one direction or into another direction, whether can all the startups grow really big?
Well, so, I mean, from my perspective, as we invest mostly Series B, but some Series A, our, like a business that is, their ultimate goal is to be valued at 20, 30, 40 million is just not even going to be investable for us. That would be the value, that would be lower than the valuation when we invest. So we are biased towards companies that have bigger ambitions. And I think that it doesn't always require a ton of capital to even achieve those ambitions. We're seeing creativity around freemium sort of self-service models that don't require big sales and marketing investments to grow fast. But in general, I would say that's something that actually holds us back from investing in Europe, is that a number of the companies that we look at are growing nicely. They're burning a little bit of money, but they don't have quite the ambitions that we would look for, where they're looking for hiring like one US salesperson to extend their team. We'd be looking for them to hire a team of like 5 or 10 people in the next few months to really blow up their growth. And so there's a mismatch in ambitions and the expectations of VC investors.
Okay, so whether you would look at companies that don't have the ambition of becoming a unicorn?
Well, one of the mentors in my life, he told me, Bogy, if you can spend your time building something really big, like it takes the same amount of energy, right? I mean, think big, because it takes the same amount of energy. So work on the biggest things that you can identify at any given time. So I took his advice very much to heart, but it doesn't always work like this, right? Sometimes you find yourself in a situation that, you work on certain assumptions, and I think it's good to also be wise, because sometimes you have to exit at the right time. Even if you get an offer, which is, I don't know, $20 million, you may think, okay, I should be a unicorn. But nowadays, things change very fast, right? I mean, the winds can be against you. For a moment, they are with you, but they could be against you. So generally, I would say, never throw away a good offer, but ambition is another thing, I mean, your state of mind is definitely to go for the stars.
Mm-hmm. Robert, I have a special question for you.
Okay.
Because what else I have seen, because we have some kind of common history, that very often startups go for fundraising, and in course of that fundraising process, they actually get acquired.
Yeah.
So how do you comment on that?
Well, I think sometimes it's something that you do on purpose, and it's called in our industry a dual-track process, where you say, look, we're going to be raising money, but we're also going to be trying to sell the business. And that's often the case if a startup is running out of money and you're not sure that you're going to be able to raise some more money. You will sometimes do a dual-track process. And the idea there is that you go to VC investors or growth capital investors and try and raise some money, but you can also approach a couple of strategics, and you can say to them, look, we're doing a fundraising. We've got a fundraising option. It's happening. We're talking to investors. If you're interested, you could participate in our fundraising as well, because we see some advantages of teaming up with you. And if the company really likes you, they might say, well, actually, now that we've seen a bit more about your business, we don't just want to invest a minority stake. We want to buy you completely and integrate you into our business. And so that's a technique. Sometimes it's really genuine. You're running a dual-track process because you're kind of indifferent whether you're raising money or selling to a good buyer. And sometimes it's insurance policy. If you're not sure that you're going to get your funding round away, then you'd like to have some buyers who are getting up to speed on the same time frame so they can make you an offer. And we've seen some really good examples. We took 2 major global banks right up to having definitive agreements, all the legal documentation finished on a 10 million euro investment or an acquisition. And the management of the company actually really decided, and they said, we don't want to do any more fundraising, we're tired, it's been too painful, let's sell and be part of a big bank, but with a very dynamic team who really wants to change the industry. So it's a nice technique. It can actually bring you some really good results. It can be a little bit more complicated because your cap tables that you're working with and so on can end up being quite different, but you can often manage it quite successfully to give yourself that freedom of choosing 2 different options or having an insurance option if your fundraising doesn't really work out.
Very good. So I have a question for the audience. What do you think, in which industry your startup has to be to get acquired with a higher probability? So, wild guesses. In which industry the startup has to be in order to get acquired or get a good exit? In what? Marketing. Food. What else? IT. We got 1, IT. Fintech. Second, there's 1/3 field of business. IT is the first one. IT, all kind of software companies get acquired with a higher probability. Second was fintech and banking. And the third one is in which business? And it's not food. So, what do you propose? Gambling, gaming. It's partly IT, I would say, because it's mostly software development there. Or okay, you meant true gambling. It's not true. So, the third one is, any other guesses? Biotech. Almost not exactly. Medtech is actually pharmaceuticals, because the pharma companies have a lot of money. So, what else would you like to know from the panelists? Where do we have a microphone? Okay, please.
I think this works. So, question to Robert, what are the prerequisites for outbound process these days? So I'm Elbrus with 3TS Capital. So we have been investing in the region for the last 18 years. And we have seen over time that the outbound process requires some financial maturity in the company, reaching certain scale. But what are the prerequisites these days? Because we have some companies we should talk about, by the way. So, yep.
Okay, I'm going to be in the restaurant area for most of the day, outside in the sun. So happy to talk to anyone. Well, I think there's a couple of things. One of them is sometimes you've got to sell, and you're not choosing the time of selling. You just see that your runway is running out for whatever reason, and you've built something good. It's got to be valuable to someone. In that case, don't hang around, get on with it while you've still got some cash in the bank and get something done. If you've got the chance to choose, and I'm talking here mainly about B2B software in the European context, when you've got a run rate of around 5 million euros or dollars or pounds, you've got a good chance of success. If you get past 10 million, it kind of picks up some more. We don't see that many companies that are doing 100 million. I suspect that it gets even better at that point. But I think the sweet spot, for people in a room of startups, what is a realistic goal to go for in the next couple of years where you can start thinking about an exit to an international buyer? I think 5 million of recurring revenues, 10 million of recurring revenues, you'll get a good outcome, maybe a great outcome. If you can actually build your company with sales, with a good financial model, with a good infrastructure to keep growing. Don't sell early, keep going. But if you can't get that right team together, then I'd say go to that sort of $5 to $10 million recurring revenue limit, and you'll find people who are interested in buying you for European presence, for technology, for certain skills. So that's about it. We find that growth tends to be more important than profitability. So if you're growing at 50% a year, people like you. If you're growing at 10 or 20% a year, it's harder. But there are always going to be some buyers who don't want to buy a loss-making company. So you'll find people who are interested, but some of them will then drop out if they see that you're loss-making. So the ideal moment is when you can see that you're going to be profitable in 6 months' time. You're growing nicely, and at that point, it's a good time to start talking about, how do I get ready to sell? One last thing before I let other people speak is, I find it really wise to get to know some of your potential acquirers 2 years before you exit. And typically, you've got a lot of great engineers who build software and they're internally focused on their product. They've got to look up and get to know some other people out there so that they have a personal relationship with the buyer and so that they know that what they're working on is somehow on the roadmap of a potential buyer. And so I'd say also, 2 years before you want to start selling, at least go out there and talk to people, have some coffees with some people and so on. 6 months before you go profitable, that's a good time to actually sort of engage bankers, start getting ready. And then a nice target to aim for, somewhere between 5 and 10 million. You'll get an exit. If you can keep growing beyond that, keep going.
Okay, we have some more questions. Just the gentleman there, exactly, and then you.
Thank you. You've mentioned several times now that the exit value is driven by the recurring revenue and the kind of innovative core of the company, so to say. Have you seen, or would you comment upon the value of the brand and the kind of marketing side of the startup at the moment of exit? Thank you.
So, if that's to me, I would say, because I work with B2B software companies most of the time, brand is important, but it's not the main driver of value. I think where branding is most important is actually helping you get those that revenue growth. So if you're not spending on marketing, then you're probably not going to be growing very well, and that's a pity. I don't work with consumer-facing companies where the brand becomes very important. But it can, of course, be very important for people, yeah.
So, Kyle, what do you say? Is brand important? Do you pay extra for the brand?
Well, in any sort of B2B context, the acquirer generally would be leading with their own brand. So they're not buying you for the brand. But to the extent that you have great reviews, a great user experience, great NPS scores, and all the things that go into, like, customers love you, that all brings a halo into the deal, because that will impact your retention rate, that will impact how much risk the buyer sees in the deal. On a consumer side, it might be a different scenario, but yeah, I would agree with Robert said.
And probably in deep tech and maybe in medical pharma technologies, basically IP is extremely important. So your protection, and sometimes you get bought before you have actually any revenues. So people buy for different reasons, right? Mm-hmm. But software is probably, you have to prove revenue.
The conclusion is that basically you have to know the buyer. And what I have seen pretty often is that if the startup is building themselves, like the team is building the company for the VC investor, and in one moment the VC investors like basically turn them down because they don't grow so fast and they are not so attractive, then they end up with a different type of buyer or different type of an investor probably, but you still have to know the market. What a surprise, we have to wrap up because we have used almost all our time. So it has been a very short session, I would say. So you had a question, a short one? You need a microphone, so please.
In my case, I'm building a company with an ambition to grow big, but I want to keep being a founder until the end. I don't want to sell it. But in order to grow that big, I really need investors. And my actual co-founder keeps telling me that you cannot bring investors if you don't plan your exit. And I say, I don't actually want to do the typical exit. I want just to bring dividends to the investors, like the old-fashioned way probably for now investors. So what kind of advice can you give me?
Whom do you want to pose that question from the panel? Whose answer do you want? Bogies. So you will have a session together after the current panel, because then it will be like more deep answer than Bogy can give you in the next 20 seconds. So, very good. Anybody else who wants to pose a question to a certain panelist just after the session or throughout the day today? Hand up. So, you have a question for... Kyle knows that you will have a chat together after the session. Anybody who wants to have a question for Robert? No? You want to have a question for Kyle?
I want to make a comment.
You want to make a comment, please.
Yeah, I think this is really useful discussion that you're having. I am an ex-founder myself, just did an exit 6 months ago. I've had a little bit of M&A background, so I know how gruesome an M&A process is. I think most startups fall into a place where they are before the 5 million mark, and they also have the chance, if they run the process right, to sell for a couple of million, and that's already a success. So I just wanted to give some encouragement words.
And your name is?
Raimons, Thunderful.
Raimons, absolutely. Thank you for the very good comment. So, I know your startup. So, now our time is up, but I would pose one more question to the panelists. Just give one takeaway from your experience, what it is the startup founders should keep in mind in preparing their company for the potential exit. One thing.
Yeah. Start conversations early, because you want to be dating before you marry and have a long-term home, and your partner does too.
Thank you, Kyle. Bogy.
Create options. Never count on one solution.
Thank you, Bogy. Robert.
Don't neglect sales and growing your revenue at the expense of focusing just on your product.
Thank you, Robert. That is basically all you need to know as the startup founders, and then you will have the stars. Thank you very much for that session. I'm sorry it was a short one.
Okay. Thank you.